Execution is often treated as the solution. In reality, execution without validation creates cash risk. Most businesses don't run out of opportunity. They run out of liquidity. Revenue may be increasing. Activity may be expanding. Pipelines may appear full. But cash availability begins to tighten. Because execution amplifies what already exists. If the system is proven, execution creates scale. If the system is unproven, execution creates instability. That distinction is not obvious at the beginning. It becomes visible only when liquidity starts to compress. This affects founders operating in growth environments, agency owners expanding delivery capacity, service businesses onboarding more clients, operators increasing headcount to support demand. The assumption is consistent. If we move faster, we grow faster. If we execute more, outcomes will improve. But cash flow does not respond to effort. It responds to sequencing. You can increase output and still reduce financial stability, because growth activity and cash movement operate on different timelines. Execution accelerates commitments. Cash follows its own schedule. By the end of this video, you'll understand why execution without validation creates liquidity pressure and how to structure growth without destabilizing cash flow. The common belief is simple. We just need more sales, more outreach, more marketing, more deals closed. It feels logical. If revenue increases, financial pressure should decrease. But this ignores timing. Revenue is recorded when a transaction is recognized. Cash is received when payment is collected. Those events are rarely aligned. At the same time, commitments begin immediately. Hiring is executed before revenue is collected. Marketing spend is deployed before conversion is confirmed. Operational capacity expands ahead of cash inflows. So the business begins operating on expected inflows rather than actual liquidity. Signed contracts create confidence. Collected cash creates stability. Execution tends to prioritize the former. As execution accelerates, pressure compounds. Hiring increases payroll obligations. Marketing expands. Spend before return is proven. Software subscriptions add recurring costs. Operational commitments grow in parallel. From the outside, the business appears to scale. Internally, timing pressure begins to surface. Receivables are reviewed more frequently. Payment follow-ups become more urgent. Vendor payments are delayed. Approvals slow down. Payroll timing feels tighter. Revenue has not declined. But liquidity feels unstable because the timing between inflows and outflows has shifted out of alignment. Execution increased volume, but it did not align cash movement. There are three core risks driving this pattern. First, revenue is not liquidity. Revenue reflects performance over time. Liquidity reflects available cash at a moment. A business can show strong revenue and still lack the cash to operate. When leaders rely on revenue alone, they miss timing gaps. Second, fixed cost sensitivity increases. As execution scales, fixed costs rise. Payroll expands, subscriptions accumulate. Operational overhead increases. These costs are inflexible. They create consistent outflows regardless of cash timing. As fixed costs rise, the margin for timing error shrinks. A small delay creates disproportionate pressure. Third, Decision timing exposure. Execution decisions are made based on projected outcomes. Hiring is justified by expected demand. Marketing by anticipated returns. Expansion by forecasted growth. But projections are not cash. When commitments are made before validation, the business becomes exposed. Cash arrives later. Costs begin immediately. That gap is where risk builds. Consider a simple example. A business generates $250,000 in monthly revenue. Payment terms are 45 days. Fixed costs are $140,000. The company accelerates execution. 2 hires are added. Marketing increases by $40,000. New tools are introduced. Fixed costs rise to $200,000. In month 1, revenue is recorded at $250,000. Cash collected is lower due to timing. Expenses of $200,000 must still be paid. In month 2, revenue increases to $300,000. On paper, growth is strong, but cash from month 1 is only now arriving. If collections are delayed or new clients follow similar terms, cash inflows lag behind commitments. The business appears to grow, but liquidity tightens because execution moved ahead of cash conversion. To manage this, 3 principles are required. First, separate revenue from cash metrics. Track what has been earned independently from what has been collected. Revenue shows performance. Cash shows capacity. Second, sequence commitments after cash conversion. Do not expand fixed costs based only on recorded revenue. Wait until revenue consistently converts into cash. This reduces exposure to timing gaps. Third, stress test fixed cost expansion. Before increasing commitments, evaluate performance under delayed inflows. If the system holds under pressure, expansion is controlled. If not, execution should be adjusted. If this discipline is ignored, fragility increases. The business begins relying on credit to bridge timing gaps. Decisions become reactive. Leadership attention shifts to short-term survival. Opportunities are missed because liquidity is constrained. Growth continues, but stability declines. This is not a revenue problem. It is a sequencing problem. Execution is not inherently risky. Unvalidated execution is. Revenue creates movement. Liquidity determines survival. The businesses that scale effectively are not the ones that execute the most. They are the ones that align execution with cash timing and financial structure. If you value structured breakdowns like this focused on financial control and operational stability, subscribe for more strategic insights.